I'm Howie Lim. This is Money Hacks by the Business Times. Tech has redefined the global economy and created trillion-dollar companies at breakneck speed. From AI and blockchain to crypto and big tech, fortunes are being made and lost every day. But for most investors, figuring out how to ride the next wave remains a mystery. How do we recognize and realize technology alpha, the outsized returns generated by tech-driven investments? And how do we distinguish winners from hype, identify the sweet spot in the technology lifecycle, and manage the risks of volatile sectors? Welcome to Money Hacks, a podcast series by the Business Times, where we explore useful financial tips to help you on your money managing and wealth growing journey. I'm Howie Lim, and we've got expert help from Igor Pejic, author of Tech Money. Igor, thanks for joining us today.
Hello, thank you very much for having me.
We're talking about tech companies and their role in the stock market. Since these high growth tech companies often don't make a profit just yet, how does one figure out what they're actually worth, given that the usual price to earnings rule doesn't quite apply? And also, investors tend to have this, I'm just going to invest in a company I like, whether or not it's a good investment is another story, right?
That's actually an excellent question because E/E ratios that you mentioned have been the gold standard for so many years. They have been the most important metric in all of value investing throughout the 20th century. And price to earnings ratios are still important, but only as one component of a larger set of growth metrics. In the age of tech, there's also many more important factors than pure financial metrics to consider, especially whether a technology back the company is riding, whether that technology is catching up, what's the total addressable market, how it's changing the whole game, and things like, what's the company's positioning in the supply chain, what's the mode, how is it positioned to capture the tremendous upside of the new tech revolution. Warren Buffett reportedly said he looks for P/E ratios below 15. There's hardly a big tech company that's below 30, 40. Some of them are in the 300-400 range. One of the factors that I look at particularly is price to sales ratios. It gives you an idea of how big is the company's business, and especially how well is it growing. Now, this unfortunately gives you only a view of the equity side of the balance sheet, meaning, what is the company really bringing in?
But that doesn't tell you much about the financial health, though. What else can we look into or should look into?
What you could do here is look at EV through sales ratios, meaning the enterprise value, where you not just take the market cap, but you also factor in the cash and cash equivalents on the other hand, but also the debt, just to make sure that it's a healthy business. It's not completely financed by irrational debt and that you're not overpaying. Now, what's equally important for growth companies in general, but especially tech companies, is the R&D to sales ratio. So how much is a company really paying for the future, right? So price to sales is more or less telling you how well is the company doing today and how well was it doing in the past. But R&D to sales, that's how well it will be doing in the future. And that's why many of them have bad price to earnings ratios. But if you have a company with a high R&D ratio, that's extremely important. And we see that there is no big tech winner that doesn't outperform others by several magnitudes in terms of R&D spending, especially those companies that are categorized in non-tech sectors. So for example, Tesla is categorized as a car manufacturer, but it's outspending all of its peers in R&D. Amazon. Retailers spend generally about 0 to 1% of their income on R&D. Amazon is spending 15%, which is a tremendous difference. Meta, 27% versus other communication companies that are in the low single digits.
Wow, that's a really big gap.
And it's a good sign of whether a company will be successful tomorrow. What I also look at is free cash flow. How much cash is it generating? How profitable is it? This is becoming more and more important as new technologies require more and more capital to be deployed. We're talking about Gen AI. Hundreds of billions of dollars are invested by those big tech companies. And this in itself has become a moat. It's a competitive advantage. If you don't have to pay interest on hundreds of billions of dollars, that's a huge advantage. And you can stack all the more GPUs in your data centers because you save money elsewhere. So free cash flow is often negative for highly growing companies. But if you get it positive in combination, with a good R&D ratio, good price to sales ratio, that's a really, really good sign that a company is well positioned for the future. There's two more things that I look at in terms of the quality of the growth. One of those metrics is customer acquisition costs. How much does it cost you really to gain new customers. Because if you have low acquisition costs, obviously you can gain more customers or buy more customers, buy more market share, which is especially important in platform businesses. But on the other hand, it's a sign of product quality. If you have to pay very heavily to get a customer on board, there might be something wrong with your product. And we see that in the fintech area, where we see many fintechs paying $100, $200 for customers just to use their free services. Now, if you have to pay somebody $200 to use your services, it's likely that you're not offering the best product in the market. The second thing is churn rate. How many customers are you losing? Again, if you're paying a lot and then most of your customers leave you and you have to pay a lot to get them, we have the same thing, right? On the one hand, you lack the budget to grow. But on the other hand, if many customers are leaving you, that's probably a sign that your product is not the best in the market.
The majority of what you've said, though, Igor, kind of points to money, sales, how much it costs, etc. So besides money, though, what can we look at when it comes to companies that would decide it's a good buy, it's a good investment?
Mm, it has changed, right? Because in the past, it was mostly about financial metrics. Now, I believe the most important thing is to catch those tech waves and the companies that are riding and benefiting of those tech waves. The question becomes, how can you tell a successful technology company apart from a non-successful one? One is the productivity increase that you get either by the technology or by the product specifically. On the one hand, functional, are you able to do something else you were not able to do, something that's of value? Or are you doing things more efficiently, quicker, or are you doing them cheaper? And that's both important on a customer level, but also on the corporate customer level. Gene editing was such a thing with CRISPR technology where we had costs in the millions of dollars for one process. And then they were brought down to a couple of $100. And all of a sudden, it was not just a domain of science and research, but you could do personalized medicine. You could really treat very rare diseases. If it changes something to the cost structure, that's significant. And the other is the adoption, because adoption is a direct result of the productivity promise. And this is the key metric of everything else. You need to see customer adopting a technology or also a product. Otherwise, nothing else will help you. A negative example, the metaverse. Metaverse is like Decentraland or Sandbox that had a value of $1.3 billion. But then you had like 30 users, or Meta's Horizon World reportedly was supposed to invest $100 billion over the course of a couple of years, and they had 900 active users. So that's a really expensive daily active user. So if you see low adoption, especially low paying adoption, right? So there's a difference between users and customers. That's a major warning sign.
Some of the less sexy things to talk about, say rules and such, surrounding the need to keep data private these days, or the rules around social media, as we're seeing. How much does that affect the long-term value and also the risk for these different types of tech companies?
I think very much so, especially those big tech and Mac 7 companies are exposed to. And we've seen this building up over the last couple of years, much of this coming especially out of the European Union and being adopted worldwide. Data privacy regulation, you had PSD2, which fostered open banking mandates. Now you have the Digital Markets Act, which is antitrust related. Those are all significant risks to the operations of those companies. Quite frankly, as a customer, I think that's actually a good thing because I like data being kept private. Governments are protecting children from social media, and open banking is giving us all of those great new products. But from an investor perspective, it's a big risk. I tried to quantify this, and one of the variables I looked at was a lobbying spend. US companies, the big tech ones, or internet companies in general, between 2000 and 2025, they increased their lobbying expenses by 1,560%, which is a drastic increase. So every year it's basically just going up, and that's just the US. In other places, it's even more. The narrative is usually the big tech companies are buying laws. It's unfair, but actually, it's the other way around. Actually, as an investor, I would prefer those lobbying expenses to go down because what they tell me is those companies are under a lot of pressure. I think every investor would do well to diversify their tech portfolios just in case there is a regulatory pressure, there is a big market breaking down. The best way to do so is also to venture into tier 2 tech, which is under the radar, but also to have some of the scale-ups in your portfolio.
Still to come, we find out which tech companies are worth investing in this ever-evolving blink and you'll miss it sector. More with Igor Pejic, author of Tech Money, in a moment.
Lens on Singapore is now bigger and better. The same deep dive exploration of socioeconomic and geopolitical issues which impact our lives here in Singapore and the region is now a video podcast. If watching a conversation is your thing, join Claressa Monteiro in monthly conversations about things that matter. Subscribe to the BT Lens On playlist in the podcast tab of the Business Times YouTube channel and start watching today. BT Lens On Singapore, now available in audio and video.
And now, back to Money Hacks from the Business Times.
Welcome back. So, Igor, we were talking about tier 2 tech companies, right? Who, for example, second tier tech that the market maybe hasn't fully appreciated.
Definitely. So I don't want to mention specific companies and I'm not giving investment advice, but tier 2 tech, I don't really like the name, to be honest, because it sounds like they are some small companies, but actually tier 2 tech are giants by themselves by any kind of measure, just that they're not Mag 7 companies. Like they have hundreds of billions of market valuations, and they're extremely strong players in certain segments, certain niches, like Oracle, IBM, SAP, all of those big giants. And because they are really stable, they are under the radar, no regulator will try to take them public and sue them. And that's why they are usually a little bit shielded from this kind of pressure. And there can be a good stabilizer, especially since they are usually more mature companies with very stable earnings. They don't fluctuate that strongly as, let's say, those new scale-ups that could be disruptive to certain industries.
The AI ecosystem they're part of, or how would you categorize them really? Since if we're not wanting to talk about them in a tier 2 manner, are they adjacent? Are they, enablers, adapters?
So most of them are definitely enablers. They're doing the quote unquote boring stuff, the infrastructure one that you don't really read a lot about because much of it is scale business. They have more characteristics resembling of traditional companies. So they don't have these exponential growth curves, but they still can have very significant growth curves if spending is up there. So there's a lot of potential, but they behave by somewhat different rules. So they can be really stabilizing assets in the portfolio.
How else can we go about making sure that our investment is a good one, particularly in tech stocks and tech companies, Igor? There seems to be so much we have to keep an eye on these days.
Definitely. So there's a couple of things to look at. We discussed the financial metrics. I mentioned adoption. Adoption is really, really important. One of the concepts that's often forgotten that it's also very difficult now in the tech age is the concept of total addressable market. So what's the trajectory? Can a technology open up a new market, for example, or is it limited? Because we've seen this time and time again. The traditional value investor would say there's only 100 million, let's say, of expenses in that area. And if you capture 70% of the market, that's kind of total addressable market. But in tech, usually you get new functionalities, which means that sometimes you get a completely different market overnight. It's the same with classical computing. And then all of a sudden you had cloud computing wave, and then SMEs were able to get this compute. So it basically changed the game. With tech, it's very important to look at the trajectory. Is there room to grow? And the other thing, which is more advanced and more difficult to pull off, but I think that's where the most reward happens, is to anticipate convergence of certain technologies. So it's very important to have the range to read a lot on different technologies. If you look at those breakthrough moments in the last couple of years, the input was coming from another field.
What do you mean?
To give you an example of electric vehicles, this was a technology that was dormant for a very, very long time. We had EVs 100 years ago, but it never made it big. Now, what happened was that consumer electronics had rapid advances in terms of battery technology that those could actually power cars. And that's what enabled Tesla and others then mass produce electric vehicles. Or if you look at mobile payment, this was also an area that has been around quite long, actually, but it took the entry of Apple into the space, onto the iPhone, and to use their contactless interface to have the breakthrough. The same with cloud computing, but only once AWS got into the race and with a different approach did it change the complete picture. So if you want to really benefit or anticipate those breakthroughs, it is very, very important to be well read across different kinds of discipline and segments. So you really need a big area of interest if you want to be successful in this.
Do we have to keep an eye on the macroeconomic situation of the markets as well? Because interest rates may hurt, say, the value of growth tech stocks, for example.
The way I like to think about there's two types of cycles, right? So there's those deeper technological cycles and there's more superficial or more shallow macroeconomic cycles. So in the short term, definitely those macroeconomic cycles hurt tech companies a lot because they are what we call high beta stocks. They are volatile but connected to the market, which means if the market goes up, they go up even much more. And also the other way around, right? So if interest rates, for example, go up, then investors are more cautious, but they're even more cautious with tech companies. Now, I'm saying that those cycles are shallow because they have a strong financial impact on the stock exchanges, but they have a limited impact in terms of business. Because even if interest rates go up, or even if we have a recession, right, companies will not stop spending on things like cybersecurity. They will not turn off their firewalls. They will not stop ordering iPhones or laptops. So usually IT spending, the real spending, you could exclude companies like Meta and Alphabet that are highly dependent on ad revenues. But overall, tech companies, in terms of the bottom line, are not so much impacted by the macro as their share prices, which means that they can rebound very quickly. If the macroeconomic mood changes, investors are more willing to take the risk, then they definitely could have a quick comeback. So more important to track those underlying technological cycles that are taking many, many years, sometimes even decades. It's very, very difficult to know what will happen in the next year or two.
What do you make of what's happening with software tech then? Some are saying that its time is over, some are saying not quite yet.
Yeah, so it's a very, very good point because there was this massive sell-off when Anthropic announced its cloud model. I believe it was an overblown panic, to be honest. Investors usually, when they panic, they sell off every stock, but you should be cutting out those that are really at danger, and some of them are at danger. But again, it's very difficult for me to imagine that, somebody will vibe code their firewall just because there are new possibilities. And I was also quite surprised because ever since Gen AI came onto the stage, they were telling us that software developers were the ones to be cut. And every study told you this was the number one disrupted profession. So I don't know where this surprise came from because we had this investment hypothesis when cloud came out with the new capabilities. Sure, maybe it accelerated the timeline, but if you didn't think that a certain software company was a good investment a year ago, why didn't you sell it back then? So I think it was an overreaction. There definitely will be impact on the software stocks, but all of those AI shocks that we've seen, and we've seen this a couple of times also with DeepSeek, but eventually they recovered pretty quickly because we all know that we will still need companies around. I don't think that any company will be coding their software anytime soon by itself, even though the possibilities might become much more easily
This makes it
available.
this makes it tougher though for a regular investor, doesn't it? How are we supposed to distinguish between what's really game-changing tech from just hype or knee-jerk reactions and so on?
It definitely is, especially if you want to be really, really early on. That's why you need to track those other indicators like adoption, like customer acquisition costs. Usually, this gives you a very good picture of where things are catching up. But the other thing is also scenario planning. This is, I believe, maybe one of the most critical skills of a tech investor. You have to be prepared for multiple scenarios of the future. But when you're investing in technology, it's all the more important because if you're investing in traditional sectors, there might be a difference in growth rate between 3 and 5%. But in tech, it can make the difference between growing 100% and going out of business. So there's always these standard wars. You don't know how they will mature. So the best way is really to back companies that are going after different kinds of strategies. So to make sure that you will have a winner regardless of what the future might look like, at least to have the 3, 4 most likely scenarios covered.
Right now, though, there's a positive long-term outlook for the entire tech industry. What should we be looking out for? What should we be cautious of?
So there's, I think, a number of possible shocks that could happen in the near and short term. Now we're seeing all those global tensions, and they could disrupt global supply chains. For example, chip manufacturing is highly concentrated in Taiwan. if there is any kind of superpower clash, whatever that is. This could have a serious impact. We could run into an energy problem. Those AI models and data centers are extremely energy hungry. Who knows if we can provide them with this, especially now given that many of those global conflicts are occurring in countries that are rich on oil and gas, and that is a risk too. So there are many, let's say, short to midterm scenarios that could happen. Overall, in the long term, I don't see anything that could derail really this technology, because if we look at the corporate valuation lists that we've had in the past, always every 10 years or so, there used to be a rotation and there used to be new companies coming, automakers, and it was energy giants and financial giants. But ever since 2000s, it's been pretty much tech companies, and they have just been growing and growing and growing. And for good reason. It's hard to imagine that there will be any kind of other industry that disrupts tech. Let's be honest, those big tech players today, they could be disrupted. Like maybe in 10 years, we don't have a TSMC or an NVIDIA here under the top 10. But if they are disrupted, I'm pretty sure they will be disrupted by other tech companies. I don't see how we are getting back to an age where you have traditional physical goods companies running the economy or the majority of the economy.
Money Hacks takeaway order 260 is up. Tech alpha isn't found in PE ratios, but in adoption and R&D spend, the seeds of future growth. Beware of regulation and hype though. Diversify, anticipate tech convergence, and invest in enablers doing the boring stuff to stabilize your portfolio. A big thank you to Igor Pejic, the author of Tech Money.
Thank you so much for having me. It was great.
I'm Howie Lim, and this has been Money Hacks by the Business Times.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.